Hello, my fellow investors, and welcome back to another viewer requested fundamental analysis video. Guys, earnings for Q3 has started, and I still got 3 companies on these wheel that I really do need to just do. So we're gonna cover these next couple days because I really just want to focus on the earnings, seeing that yeah, it's gonna be I think it's gonna be a very, very good earnings season. So with that said, let's spin this wheel and see what company we should analyze today. Oh, that's really close. And it looks like we got the company RMR. Now this one was brought up by none other than Tony. Okay, great. So Tony, we're gonna take a look at RMR for you, and let's see, of course, their fundamentals and what their previous earnings were from, I believe, Q2, and then whether or not this company is a great to buy at this moment or not based on valuation. So with that said, let's get started with this analysis. Alright everybody, so here we have the company RMR, and right off the bat, I have no idea what this company is. Straight up, like I was just inputting in all the numbers in, and to my surprise, this is a REIT company. However, it's a REIT company that has capital expenditures, and I'm just like, wait, what in the world is this? So this is very, very strange right off the bat. We're gonna get into it. However, let's take a look at first what this company actually does. And taking a look at the company profile, we can see the RMR Group Inc. through its subsidiaries, the RMR Group LLC, provides businesses and property management services in the United States. The company offers management services to its 4 publicly traded real estate investment trusts and 3 real estate operating companies. It also provides investments, advisory, and administrative services. The company was formerly known as a REIT Management Research and changed its name to the RMR Group, right? REIT Management Research. In September 2015, the RMR Inc. was founded in 1986 and is headquartered in Newton, Massachusetts. So here's the thing, right? This is a REIT company. However, what they do has nothing to do with REITs. So I think it's mainly because of the fact that they do say that they have over here 4 publicly traded real estate investment trusts. So they own this, which is why they're classified as a REIT company, even though they themselves are not. And I think that's the reason why they have capital expenditures. However, they don't have a forward revenue growth. So this is going to be, I don't know, this is going to be quite an interesting one. Now, let's take a look at their past earnings. So EPS normalized actual came in at 48 cents. It was missed by 34 cents. EPS gap actual of $1.48. It was a beat by a whopping $1.02. And the revenue, $280.23 million, beats by $52.71 million. So coming over here into the calculator, we got the ticker for RMR, market cap of $742.25 million with a P of 4.63 and a current share price of $23.48. This current share price, guys, is down 7.6% on the 1 year, and year to date it is down 17.27. 52-week range, it is $20.79 to $31.55. So not near 52-week lows, but you know, kind of there, right? Kind of there, especially with the REIT sector falling that much in the past couple weeks, right? Now, again, I know this company isn't necessarily a REIT company, but it is categorized as one, so we're going with it. Now, they do pay out a dividend of $1.60. This is a yield of, I kid you not, 6.81%. So when we see what $5,000 buys you on this would probably be upwards of like $400 or so. Now the payout ratio, take a look at this payout ratio, 43.36. That is tiny. 5-year CAGR of almost 10. This is a little bit concerning, though only 1 consecutive year of dividend payment. However, take a look at this dividend history though. Wow. So they have had instances where they do increase it. For example, in 2019, it was 35 cents. And then, well, also in 2019, they increased it to 38 cents. Then they kept it at 38 cents for a while. They did a special dividend in 2021, September 1st. And then as of, let's see, they did increase it recently though. Yes, as of July 21st, 2022, hang on a second. As of April 21st, 2022, they increased it from 28 cents to 40 cents. So very, very subtle. If I want to take a look at this in the 10-year though, you can see that they really have never had like a drop, right? Only from 2016 they dropped it from 30 cents to 25 cents. But aside from that, this is very, very consistent, guys. Yeah, it's not necessarily what you want to see when it comes to growth, but man, with a 6%, almost 7% yield, you may just want to be like, you know what, that dividend is massive. They don't seem to cut it often. They do a special, well, at least they did a special one, and they're just very consistent when it comes to it. So with a payout ratio of 43, not that bad. I want to take a look at this payout ratio though in regards to the cash flow, seeing that they do have a cash flow. Nonetheless though, ex-dividend date is actually coming up in 5 days. Well, as if you guys are seeing, this will be 4 days, but yeah, this is interesting. Payout date will be on November 16th, and they pay their dividends quarterly. Gonna be an interesting one, guys. Very, very interesting, especially for a dividend play if you so wish to do so. Not that I recommend that though. Coming back over here, we can see that based off the current shares outstanding and this $1.60, they pay out $26.56 million in dividends every single year. And take a look at this. After this is paid in regards to the 5-year average free cash flow, they're left with $108.1 million. And the last year's free cash flow, it is $73.64 million. Definitely a problem, seeing that their free cash flow is falling, but these payout ratios are super small. 26.5 for the last year's free cash flow, and 19.75. Guys, they can afford this dividend. Now, I don't necessarily like this though, but I want to see if this is a trend or is it just a blip. So here we have the fundamentals, starting with net income 5 years ago of $96 million to 1 year ago $34 million. Take a look at this massive drop. During COVID, it went down to 28.28. Now, this is a 65% drop. However, guys, you could see that it wasn't just a COVID thing. They were going down from 5 to 4, and they even went down from 2 to 1. So all in all, I'm not necessarily liking this. I'm going to give this like a 25%. The free cash flow is looking a little bit better, but we can still see some similarities. 5 years ago of $227.9 million to 1 year ago of $100.2 million, decrease of 56% with an average of $134.64 million. Again, COVID hit them hard, but they were going down even before then, and they went down from 3 to 2 years ago as well, though they did bring it back up as of 1 year ago. Very, very interesting. I'm curious as to where they might be at today. All in all though, I think I'm going to give this a little bit of a higher grade, probably around like a 35%. The revenue is pretty much exactly the same as the other two. Profit metrics, we got 5 years ago of $352 million to 1 year ago of $200 million, decrease of 43.15%. The drop here happened during COVID, but we don't have any other decreases afterwards, which means at least that's a little bit better. But again, 5 to 4, that's a massive drop. So I'm going to say, guys, like a 40%. Assets minus liabilities, we have something here that we don't necessarily want to see. Well, after COVID, their assets minus liabilities dropped. Now, after that, 2 years ago to today, they are increasing it, but still not necessarily something that you want to see. Average total assets, it is $598.6 million. Average liabilities is $156 million. Doing the difference, we got $442.54 million. I'm going to say, guys, roughly like a 50%. Cash flow minus liabilities is actually really, really interesting because 5 and 4 years ago, we have a positive number, meaning that their cash flow exceeded their liabilities. Guys, this is so rare to see. You rarely get to see it. Now, they did drop during COVID and they went further down as of 2 years ago, but you can see that they were at the exact same spot 1 year ago than they were 3 years ago. Guys, take a look at this. Their average, it is negative 0.14. That's, if this is in millions, then this is $140,000 in the average cash flow minus the liabilities. This is great. Now, as of 1 year ago, it is a lot lower, but the fact that they have two positives, I see this as a great, great thing. So I'm gonna actually give this like a 75%. Shares outstanding, it's looking like it's very consistently increasing. 5 years ago of 16.2 million shares to today of 16.6 million shares. This probably explains why that payout ratio in regards to the free cash flow is that tiny, because their shares outstanding is so small. Guys, still though, take a look at this. That's that's less than 2.5% of share increases in the past 5 years. And on top of that, take a look at this. This trend line is touching every single one of these graphs, meaning very, very consistent. And if you take it from this is a REIT company, this isn't that surprising. So all in all, I'm actually going to give this like a 100%. This is a great looking metric. I get it. Increasing shares is not something that you want to see. But if you look at it from a REIT perspective, then it's actually normal. And if you take a look at this from, only 2.5%, actually less than 2.5% in the past 5 years, this isn't looking too bad either. So, okay, I'm going to reduce this from 100% to maybe like a 90%. All in all, it's still a really, really good solid metric. They currently hold $295.14 million with an average of $271.53 million. Now, the overall grades, given the income of 25, free cash flow 35, revenue 40, assets minus liabilities 50, cash flow minus liabilities 75, share sustaining of 90%, overall grade of 48. It's looking like it could be a little bit better, but I don't know. It's weird, right? It's a weird company to begin with. It says it's a REIT, but it's not a REIT. So yeah. So let's figure out if this is a good price to buy it at the current level. Now, taking a look at the discounted free cash flow. Well, this is interesting. Guys, not adjusting for debt 3140, adjusting for debt 8059. It's looking interesting, isn't it? Yeah, it really is looking interesting. The grade is a 50% essentially. Very, very interesting. Now, let's input some of these numbers. For the projected share buyback, this is the easiest one because, well, the fact of the matter is that they're very consistently increasing these shares at around 2.6. So for the lowest, let's say -3. For the median, let's say around the same, let's say -2.5%. And then for the highest assumption, let's say the 2%. Right? I think that's very, very fair. Oh, sorry, not 2%, sorry, -2%. And with this, we get, 30, 47, and 78, 22. Now, when it comes to the revenue, the problem with this is that if we come over here to the growth assumption, we got nothing here. We really, really don't. They have AFFO. This is the problem. It's like, is this a REIT company or is this not a REIT company? So very, very curious, I guess you could say. Now, within the past year, or at least within the past 3 years, we can see that the revenue growth has gone up from 175.7 to 200. Doing the math on this, we can see that this is an increase of 13.83%. However, I don't necessarily like that number, so for just being conservative wise, I'm going to use a much lower number. So let's give this, instead of 13.83, let's just say 5 and then 7 and then 9%. I think that's very, very fair. Doing this, guys, we get 3634 to 4205 and then adjusting for the 8995 to 10155. Margin of safety of 51015, 7646 and 9648. So this is looking interesting. Now, again, when you look at this, you're like, man, this is looking great. The dividends are 6%. Their payout ratios are super small. Even the one on Seeking Alpha is looking really small. These numbers are saying that it's great. Guys, this is a company that I don't understand. So I don't understand their business model. I don't know what they do. So, it's saying that it's a REIT, but at the same time it's not a REIT. So if you go in to look into this company, or in any company, but specifically this one, because we're talking about this one, guys, please be very wary. Just because the numbers are saying there's a great buy doesn't necessarily mean that it is a good buy, right? I mean, the fundamentals are kind of 50-50, so please do your own due diligence. If you do decide to buy into this company, please let me know in the comment section below, or if you bought it in the past, or if you still hold it, let me know as to why you bought it, right? I'm very, very curious. I see the potential in it, don't get me wrong, I do, but I just don't understand it. So if you guys have further knowledge, please let me know in the comment section below, for me as well as for anybody else, right? As well as for anybody else. We're all trying to help each other here. So this is my 2 cents on this. Let me know what you guys think. Like, subscribe, comment if you do enjoy this type of content, and of course share. That really is all we're asking for, guys. So thank you all so much for everybody who has done that. Thank you so much for everybody's support. Please remember that this upcoming week, we're mainly going to focus on live streaming as well as focusing on the earnings, because it's gonna be crazy. It's gonna be nuts. So especially on Wednesday, Tesla comes out, so it was always fun watching Tesla earnings, right? It's always fun reading Tesla's earnings. So again, if you guys would like to help, like, subscribe, comment, and of course share, we really, really do appreciate it. And now lastly, when it comes into this dividend, guys, I mean, 4% yield, that's, sorry, not 4%, 7% yield. This is just crazy. Take a look at this, putting in $5,725. What did I say? 400? There it is, $390.14. It's looking interesting, right? It is, because they haven't really cut it, and, well, it looks like they could afford it. So $390, that's a massive, massive increase in your dividend income. But again, guys, don't just buy companies for its dividend. Make sure you do your own due diligence before doing so. When looking at the options chains, guys, we're taking a look at October 20th. There is no bidder ask for either the puts or the calls. And then looking at November 17th, there's nothing still. So yeah, there really isn't anything to see here when it comes to the options. So there it is. All in all, thank you so much for the recommendation, Tony. It's a very interesting company. It's strange though, so yeah, very interesting though. Anyways, that pretty much does it, guys. Please remember to follow us on the new tech sites links in the description below. I'm thinking about making exclusive content specifically for Rumble from now on, or at least in the near future. So if you guys would like more content, make sure to follow the link in the description below for the Rumble site. All right. So with that said, peace out, and we will see you all next time.